Welcome back to the deep dive. It is Thursday, January 29th, 2026.
Here we are.
And, if you've been anywhere near a screen in the last, 24 hours, there's really only one story that's sucking all the oxygen out of the room. And it's a confusing one.
Confusing is, I think, putting it mildly. It's one of those where you look at the numbers and then you look at the market reaction and you just have to wonder if we're all reading the same report.
Exactly. We are talking, of course, about ServiceNow. They dropped their Q4 2025 earnings and a, frankly, massive strategic update late yesterday. And on the surface, this thing looks like an absolute juggernaut.
An unstoppable force.
But the market kind of shrugged. Actually, it did more than shrug. The stock slipped about 5% in post-market trading.
Which is just, it's wild. It creates this incredible tension, right? You have a company posting numbers that, most CFOs would absolutely kill for. Career-defining numbers.
Absolutely.
And yet, investors seem hesitant. They're backing away a little.
And that is exactly our mission today.
Yeah.
We're going to look past that headline stock move. You've got the earnings transcript, we've got the analyst notes, the product roadmaps. The whole stack is right here. We need to figure out if ServiceNow is, as they are now claiming, the AI control tower for the entire global economy.
Or, and this is the big question, if they're just a legacy software giant trying desperately not to get eaten by the very AI agents they claim they're going to manage.
That is the core of it. Are they the windshield or are they the bug?
Because, make no mistake, this transition we're seeing, this shift, it's a violent one. It disrupts absolutely everything.
But before we get to all the, existential dread, let's start with the perception problem.
Okay.
Because for a lot of people, and I'd bet for a lot of you listening right now, when you hear the name ServiceNow, you don't immediately think AI revolution.
No, not at all.
You think. Well, you think about that help desk ticket you filed last week because you locked yourself out of your email again.
Right. It's the, my printer's broken software. The classic, have you tried turning it off and on again? That's the reputation.
And it sticks, right? Because that's where they came from, IT service management. But if you actually dig into this report, that is not the company that exists today.
Not even close. We are witnessing a massive fundamental pivot here. We're moving from the buzzword we've all gotten so sick of hearing for the past 2 years.
Generative AI.
Generative AI. We're moving from that to something much more tangible and, honestly, for a lot of people, a lot scarier. We're talking about Agentic AI.
Agentic AI. I want to stick a pin right there because we're going to spend a lot of time defining what that actually means and why it's so different from, asking ChatGPT to write a poem for you.
A very, very important distinction.
The first, we have to follow the money. Because whatever the stock market did yesterday in a fit of anxiety, the actual bank account of this company tells a very different, very aggressive story.
It really does. And to understand why the bulls are so confused by this 5% drop, you have to understand a metric they're talking about called the Rule of 55 plus SaaS.
Okay, let's pause there. I know the Rule of 40. That's the gold standard in software investing.
Right.
You add your revenue growth rate to your profit margin. If it hits 40, you're considered an elite company.
Exactly. You get the premium valuation. You're the star of the show if you hit 40.
Right.
Well, ServiceNow just walked into the room and posted numbers that, frankly, make the Rule of 40 look like a low bar. It's almost quaint.
So break it down for us, the Q4 numbers.
Okay, so total revenue hit $3.57 billion. That beat Wall Street estimates by a solid $40 million. But the really important number, the subscription revenue, the sticky recurring stuff, was $3.466 billion. And that's growing at 21% year over year.
And just to be clear for everyone listening, that subscription revenue, that's the whole engine here. It's something like 97% of their total business.
It is the business. They aren't selling one-off consulting gigs. They are selling the plumbing, the infrastructure, a pure play subscription machine.
Okay, so 21% growth. That's the first half of the equation. That's a strong number for a company this big.
It's very strong. But here's the crazy part. Usually, to grow that fast at this scale, you had to just burn cash. You're spending a fortune on sales and marketing to get that next dollar.
The growth at all costs model.
Right. But ServiceNow posted a free cash flow margin in Q4 of 57%.
Hold on. Did you say 57%?
50.
So for every single dollar they bring in, they are keeping 57 cents as pure free cash. That sounds almost impossibly high.
It does.
Are they fudging that? Is that a real number or is it full of stock-based compensation tricks and CapEx deferrals?
It's a real number, but we have to be fair. There were some timing benefits in Q4. Really strong collections that boosted that specific quarter. Their full-year margin was 35%.
Which is still spectacular.
It's still absolutely incredible. So even if you take the more conservative full-year number, you combine a 21% growth rate with a 35% margin, you're at 56.
Well above 40.
So they're defining a whole new tier, the Rule of 55 plus post profile. It signals a company that is somehow growing like a startup, but printing cash, like a regulated utility monopoly.
It's usually a trade-off. You get one or the other. You grow fast and lose money, or you grow slow and print money. They're doing both.
Precisely. And that cash generation is what gives them armor. It lets them make mistakes. It lets them acquire companies, which is a whole other topic we need to get to.
Right.
And speaking of armor, just look at their backlog, the RPO.
Remaining performance obligations. In plain English, that's the check is in the mail money, right? Contracts that are already signed, but the revenue hasn't been recognized yet.
You got it. It's future revenue that is legally guaranteed. Their total RPO just hit $28.2 billion.
$28 billion.
Billion with a B. And the current RPO, the stuff that's going to hit their books in the next 12 months, is almost $13 billion. And that's up 25%.
So what that tells you, really, is that it almost doesn't matter what the macro environment does in 2026.
Right. It doesn't matter if interest rates stay high or if we hit a mild recession.
Yeah.
A huge chunk of ServiceNow's year is already paid for. They have incredible visibility.
So the financials are a fortress, they're a tank, printing cash, guaranteed revenue, and yet the stock drops 5%. Is that why they announced the buyback? It felt a little bit like a defensive move, like they were trying to put a floor under the stock price.
It was definitely a signal to the market.
Yeah.
The board authorized an additional $5 billion for share repurchases. But you have to pay attention to how they're doing it.
Okay.
CEO Bill McDermott, who, as we all know, is never shy about using a colorful metaphor,
Never.
he said, "We are playing offense on our tippy toes."
On our tippy toes. I saw that quote. It's such a McDermott phrase. But what does that actually mean in a corporate finance context?
It means they're not waiting around. They're immediately launching a $2 billion accelerated share repurchase, an ASR.
And an ASR is different from a normal buyback.
Very different. An ASR isn't just, hey, we might buy some stock later if the price feels right. It is, we are giving a bank $2 billion and telling them to buy our stock right now because we think you, the market, have priced it completely wrong. It's a massive, massive vote of confidence from management.
Okay, so management thinks the company is undervalued. The numbers are rock solid. So the disconnect has to be about the future. It has to be about the product, the strategy, the story.
Exactly.
Which brings us back to Agentic AI. We mentioned it earlier. We've all been hearing about AI for 2 years now. ChatGPT, Gemini, Copilot. What is fundamentally different about Agentic AI versus what we've been using? Is this just a new marketing buzzword?
This is probably the most important distinction in all of enterprise tech right now, and I really can't stress this enough. For the last 2 years, we've been living in the era of generative AI.
The chatbot era.
The chatbot era. Think of a Copilot. You ask it a question, it writes a poem. You ask it to summarize a meeting, it gives you some bullet points. It acts as a helper.
But you are still the one flying the plane.
You're still the pilot. You have to prompt it, you have to check its work, you have to copy and paste the result into an email or a document or a slide deck. The human is still the one doing the actual work.
Right. It's passive. It waits for me to tell it what to do, and then I have to take the baton back from it to actually finish the job.
Exactly. Agentic AI completely flips that model on its head. The software becomes the pilot. We are moving from chatbots that talk to you to agents that do the work for you.
So give me a concrete example.
Okay. A generative AI chatbot drafts an email for you. An agentic AI doesn't just draft the email. It writes the email, it finds the correct recipient in the database, it attaches the correct invoice by pulling it from a completely different system, it sends the email, and then it goes into your CRM and updates the record to say, invoice sent.
That is a massive leap. That's the difference between a clever tool and an actual digital worker.
It is.
But here's my skepticism. Corporate data is a complete and utter mess. I've seen the back-end systems of these large enterprises. It's a spaghetti tangle of legacy systems. How can an AI agent possibly navigate that maze without just crashing and burning?
And you just hit the nail on the head.
Okay.
That is ServiceNow's entire pitch.
Okay.
Their whole control tower thesis is built on the fundamental fact that the enterprise environment is chaotic. It's a mess. You've got hundreds, maybe thousands of legacy systems, Old mainframes, new cloud apps, random spreadsheets that someone saved on their local drive 10 years
A
ago.
digital equivalent of a hoarder's house.
Exactly. And if you just drop a powerful AI agent into that mess, it will fail. It will get confused. It can't see the data structure. It doesn't have the
It
context.
needs a map.
It needs way more than a map. It needs a central nervous system. This is where McDermott's single pane of glass metaphor comes in. The idea is that ServiceNow sits on top of all those other systems, your Salesforce, your SAP, your Oracle, your homegrown apps, and it provides the clean, unified semantic layer where the AI agents can actually live and work.
And this touches on something really interesting they brought up in the technical update call, the idea of probabilistic versus deterministic systems.
Yes.
I think we need to break this down because it sounds really academic, but it's actually the reason most big businesses are terrified of AI right now.
It is the central tension of enterprise AI. It's everything. So large language models, the brains behind the AI, like GPT-4 or Claude, they are probabilistic.
Meaning they work on probability.
They just predict the next most likely word based on all the previous words, which means, by their very definition, they guess. Sometimes they guess wrong. We call that a hallucination.
And that's fine if you're, brainstorming marketing slogans or writing a song.
It's totally fine. It is absolutely not fine if you are processing a billion-dollar invoice or approving a medical procedure.
Right. You cannot have the AI guessing that a patient is covered by their insurance policy. It has to be 100% correct every single time, or you get sued into oblivion.
Exactly. Business workflows must be deterministic. If X happens, then Y must happen. No exceptions, no guessing. ServiceNow's pitch is that they are the bridge between these two worlds.
Okay, so how do they do that?
They take the guessing brain of the AI, the probabilistic part, and they constrain it within the rigid deterministic rails of the ServiceNow workflow platform.
So the AI provides the intelligence and the language understanding, but ServiceNow provides the actual execution rails.
Perfect analogy. The AI is the powerful train engine, but ServiceNow builds the tracks. The train can go incredibly fast, but the tracks ensure it doesn't derail and smash into the station. And if you look at their new product, Now Assist, the market is absolutely buying this story.
The growth numbers on Now Assist they were staggering. They said it is the fastest growing net new product in the company's entire history.
It blew past $600 million in annual contract value, or ACV.
And for context, getting a new enterprise software product to $100 million in ACV is usually a huge milestone. It takes years.
It's a massive celebration. Hitting $600 million this quickly is true hypergrowth. And they said the net new ACV more than doubled year over year in Q4 alone.
But here's the key question. Are they just selling it, or are people actually using it? Because shelfware is a real problem in this industry. Companies buy the shiny new AI tool, the CIO ticks a box that says, "We do AI," and then nobody ever logs in.
A very fair question. But look at their expansion metrics. They highlighted that the number of deals, including 5 or more Now Assist products, increased 10x year over year.
10 times.
10 times. That suggests companies aren't just dipping a toe in the water. They are rewiring their whole operation around this. You don't buy 5 different AI modules unless you are planning a massive company-wide deployment.
They gave a couple of case studies that I thought were really telling. One was an internal one. ServiceNow is, drinking its own champagne here.
Or eating their own dog food, whatever the metaphor is.
Yeah.
The results were impressive. They used their own AI, which is powered by Anthropic's Claude model, by the way, to reduce sales meeting prep time by 95% for 29,000 of their own employees.
95%. As a former salesperson, I can tell you that prep time is real. It's a huge time suck. You spend hours reading annual reports, checking LinkedIn, looking for news hooks, trying to figure out who knows who.
And now, the agent does all of that in minutes. It scrapes the web, it synthesizes the 10K, it finds the connections in the CRM, and it hands you a perfect briefing dossier. You've essentially given every single salesperson hours of their day back.
The aggregate efficiency gain across 29,000 people is just astronomical.
That's huge. And then there was that other example they gave, big U.S. consumer services company. He didn't name them, but the stat was wild.
This is the one that caught my eye.
They flipped their entire customer support model from 80% human and 20% automated to 80% automated and 20% human.
That is the agentic promise right there, fully realized. You flip the ratio.
And this is why investors are watching so closely. If you can automate 80% of your support volume, you fundamentally change the unit economics of your entire business. Your margins explode. You stop hiring call center reps, and you start hiring AI workflow engineers.
But this raises a huge question. Whose AI is actually doing the work here? We hear about OpenAI, we hear about Anthropic, Google Gemini. ServiceNow doesn't build these foundation models themselves, do they?
No, and that's a very deliberate strategic choice. This is their open ecosystem strategy. The simplest way to think about it is the Switzerland approach.
They want to be neutral territory.
Completely neutral.
But isn't that incredibly risky? If all the value is in the intelligence, if the value is in the brain, aren't they just a fancy middleman? If I can go directly to OpenAI, why do I need to pay ServiceNow?
That is the core of the bear case against them. But ServiceNow management made a very specific, and I have to say very bold claim on the earnings call to counter that exact point.
Okay, what'd they say?
They said that in a typical enterprise use case, the LLM, the actual brain, the GPT-4 model, provides only about 5% to 10% of the total value.
Only 5 to 10%. That sounds incredibly low, considering the hundreds of billions of dollars being spent on these models. That feels almost dismissive.
It sounds low, but think about it in the enterprise context. The model itself is just commodity intelligence. It's incredibly smart, but it's generic. It knows everything about Shakespearean sonnets, but it knows absolutely nothing about your company's specific pricing tiers or your security protocols or your customer history from 2018.
The institutional knowledge.
Exactly. ServiceNow argues that the remaining 90% of the value comes from that context, the data, the permissions, the workflows that they provide. The model is just the engine. But the engine is useless without the chassis, the wheels, the steering, and the fuel in the tank.
I see. So their bet is that the models will eventually become like electricity ubiquitous, cheap, and totally interchangeable. They don't care which power plant you use. They just want to be the appliances and the wiring in the house.
That's the perfect analogy. And they're partnering with everyone to prove it. The OpenAI partnership had a really interesting detail in it about something they called computer use.
Yes. Computer use. That sounded like something straight out of science fiction. What exactly does that mean?
This is a huge deal for legacy companies. Right now, most modern software talks to other modern software using APIs. They're like clean digital handshakes.
Right.
But millions of businesses still run on critical legacy software old mainframes, clunky green screen interfaces from the 90s that don't have APIs. You can't code a connection to them. They're sealed black boxes.
So how does an AI agent get data in or out of that?
It can't, usually.
Yeah.
But computer use means the AI agent can literally look at the screen just like a human. It takes a screenshot, uses computer vision to identify, okay, that's the submit button, that's the customer name field, and then it simulates moving the mouse and typing on the keyboard just like a person would.
So it can operate software that was never built for AI. It's basically ghostwriting the machine.
Essentially, yes. It's a non-invasive way to automate the unautomatable. It opens up the black box of legacy tech. It means ServiceNow can now automate a task on a 30-year-old mainframe by having an OpenAI agent watch the screen and click the buttons. That unlocks a massive amount of value that was previously stuck in the Stone Age.
That is just wild. It bridges the gap between 1990 and 2030 without having to rewrite a single line of code.
A massive unlock.
Okay, so that's OpenAI. And then on the other side of the aisle, they have this deep partnership with Anthropic. Why both? Why not just pick a winner in the model wars?
Because different models are good at different things, and different customers have different risk tolerances. They've made Anthropic's Claude model the default engine for their ServiceNow build agent, and that's all about generating code.
So writing software using natural language prompts.
Yes, but specifically for highly regulated industries. Anthropic has built its entire brand around constitutional AI and safety. It's seen as less prone to going off the rails. So for a hospital or a bank or an insurance company, that safety profile is non-negotiable.
They need the audit trail.
They need the audit trail. They need the guardrails. They mentioned a use case where an insurance company reduced claims authorization from days to a matter of hours. But they specifically used Claude because they needed that level of safety and reliability.
Which brings us to the kill switch. This sounds very dramatic, but they really emphasized it on the call.
It's the ultimate control tower feature, and it's their biggest selling point to nervous executives.
Explain that.
Imagine you have thousands of these autonomous agents running around your company's digital infrastructure. What happens if one starts hallucinating? What if an agent starts approving million-dollar refunds by mistake because it misinterpreted a new policy update?
You can't just unplug the server anymore. It's running somewhere in the cloud.
Exactly. ServiceNow provides the governance layer. Because the agent is running on their platform, on their rails, they can monitor its behavior in real time. If it violates a policy or starts doing something unexpected, the control tower can shut it down instantly. It creates a perimeter.
So they're selling the safety net.
They're selling the governance. And that governance is what they're really selling to the CIOs and the CEOs who are, frankly, terrified of AI going rogue and causing a billion-dollar mistake.
So it's not the magic they're selling. It's the safety that allows you to actually use the magic without blowing up your company.
Perfectly put. They're the brakes on the Ferrari. And nobody in their right mind drives a Ferrari without brakes.
But let's play devil's advocate here for a second, because there is a serious bear case, and it's one that keeps a lot of SaaS investors up at night. It's this idea of seat compression.
Ah, yes. The seat compression theory. The existential dread of the entire software as a service world.
The logic seems pretty straightforward. ServiceNow charges per seat, which means per human user. If AI makes everyone hyper-productive, or if AI agents outright replace human workers, then companies will fire people.
Right. Fewer people means fewer seats.
And fewer seats means ServiceNow's revenue growth stalls and then crashes. It's a potential death spiral.
It's a very logical fear. If I automate 80% of my customer support, do I really need 80% fewer support agents? And if I do, does that mean I'm going to buy 80% fewer ServiceNow licenses next year?
Exactly. So how did they respond to that? Because that question definitely came up.
It did. And Bill McDermott addressed it head on. He basically said, look at the data, the humans aren't leaving. In Q4, their monthly active users actually grew by 25%.
So the platform usage is still growing, even with all this automation.
It is. But the deeper economic argument they're making relies on something called the Jevons paradox.
Jevons paradox. Okay, we're dusting off the old economics textbooks today. Give us the crash course.
It's a concept from the 19th century that is just perfectly applicable to AI today. William Stanley Jevons was an economist who observed that as steam engines became more efficient at using coal, everyone thought coal consumption would drop.
It makes sense. More efficient engine, less fuel needed.
But the exact opposite happened. Coal consumption skyrocketed. Because steam power became so much cheaper and more efficient, we found thousands of new uses for it. We put steam engines everywhere.
So applying that to AI, if AI makes knowledge work cheaper and easier, we won't do less of it. We'll just do way, way more of it.
Correct. We'll process more tickets. We'll analyze more data. We'll run more workflows. We'll start solving problems we previously ignored because they were just too expensive or time-consuming to fix.
And to capture that explosion in value, ServiceNow has introduced a new pricing model. It's a hybrid model.
Right. This is key. The new Pro Plus and Assist Packs.
So how does that work?
You still pay for your seats, for your human users, just like always. That protects their baseline revenue. But on top of that, you now buy tokens for the AI agents. Every time an agent summarizes a case or writes a block of code or executes a complex workflow, it burns through tokens. If you run out, you have to buy more Assist Packs.
Ah, so even if the number of human employees stays flat or even dips slightly, if the volume of work being done by the agents explodes because of this Jevons paradox,
then ServiceNow still makes more money. They make money on the consumption.
They're hedging their bets. Heads, they win with more human seats. Tails, they win with more token consumption.
It's a brilliant hedge. And they said on the call that customers are already running out of their initial token allotments and coming back to buy more. McDermott used the phrase, a hockey stick. He said, the day was coming with a hockey stick. It's happening.
So that token consumption number is the real metric to watch in 2026. If that curve goes exponential, then the seat compression argument doesn't matter. They're monetizing the work, not just the worker.
Precisely. It's a fundamental shift. It transitions them from a headcount tax to a productivity tax.
Okay, so we got the solid financials, the pivot to agentic AI, and this new hybrid business model. But there's another piece of the puzzle that clearly made investors nervous yesterday, the spending spree, the M&A flurry.
Yes, this was a big part of the anxiety. ServiceNow has historically been an organic growth machine. They build, they don't buy. It's part of their DNA.
Right.
But then suddenly, within a very short window, they announced these major acquisitions of Armis, Veza, and MoveWorks. And the market got spooked. The immediate reaction was, is their organic growth slowing down? Why are they buying so much so fast?
It's a fair question. Usually, when a mature tech company starts buying up revenue, it's a red flag. It can look like desperation, like they've run out of their own ideas.
That is the cynical take, and I understand it. But if you actually look at what they bought, it aligns perfectly with this agentic AI control tower thesis. They're not just buying revenue, they're building what you might call the security fabric.
Okay, walk us through these three acquisitions. Let's start with Armis. What do they do?
Armis is all about visibility. It's an asset intelligence platform. It sees everything that's connected to your network, not just laptops and servers, but IoT devices, medical equipment in hospitals, operational technology on a factory floor.
That seems a little outside ServiceNow's traditional wheelhouse of IT tickets. Why do they need that?
Because you cannot secure an AI agent if you don't know what it's touching. If you have an AI agent that is interacting with a connected MRI machine in a hospital or a robotic arm in a car factory, you need to know that asset exists, what software it's running, and what its vulnerabilities are. Armis gives the AI eyes on the physical and cyber-physical infrastructure.
Got it. So it extends the map from the purely digital world to the physical world. Okay, so what about Veza?
Veza is about identity, but it's not just can this person log in, it's much deeper. It's about what can this person or this AI agent actually do once it's logged in. It maps all the data permissions.
And in a world of autonomous AI agents, that seems absolutely critical.
It is the bottleneck. It's the #1 concern for every security chief. If you unleash an AI agent with the instruction to analyze sales data for trends, how do you ensure it doesn't accidentally read the CEO's confidential M&A folder or the HR department's payroll file? Veza allows ServiceNow to build a fence around the agent and govern exactly what data it's allowed to access.
It keeps the agent in its lane.
Exactly. And finally, MoveWorks.
What's their piece of the puzzle?
MoveWorks is the interface. They build an AI-native conversational platform. It's basically the sleek, modern front door for employees to talk to the entire system in natural language. It's how you trigger all these powerful back-end workflows without having to fill out a clunky form.
So if you put it all together, Armis sees all the assets, Veza locks all the doors and checks the IDs, and MoveWorks is the friendly receptionist handling all the incoming requests.
And ServiceNow is the foundation and the structure of the entire building that houses it all. The argument here is that right now, CISOs, Chief Information Security Officers, are the ones saying no to widespread AI deployment. They are terrified of the risks.
They're the brakes on innovation, in a way.
For good reason. By buying these 3 companies, ServiceNow is essentially buying the keys to unlock the CISO's approval. They are building a containment wall for Agentic AI so that the security teams can finally sleep at night.
So it's not a panic buy to juice the revenue numbers. It's a strategic fortification of their core thesis.
That is the bull case argument. And honestly, it's a very compelling one. If you want to be the control tower, you need radar, which is Armis, you need security clearance, which is Veza, and you need a radio tower, which is MoveWorks.
That brings us to the final verdict then. We've covered the Rule of 55 plus SIR, the agentic pivot, the open ecosystem, the token economy, the security acquisitions. It's a powerful story, but the stock still dropped 5%. Why?
Well, we have to acknowledge the bear case. Part of it is just valuation. ServiceNow is an expensive stock. It's priced for perfection. It trades at a high multiple. So any wobble, any confusion, any hint of execution risk, and the stock's going to get hit.
And merging 3 major companies at once is a huge execution risk.
It's massive. Mergers are hard. Merging 3 companies at the same time while you're also trying to execute a massive strategic pivot to AI is very hard. You've got culture clashes, tech debt, integration headaches. It's a lot to manage.
And they also mentioned a slight gross margin headwind, right?
They did. About 150 basis points, so 1.5%. And this is interesting. As they move more of these massive AI workloads to the public cloud, using AWS or Azure or GCP to do the heavy lifting, their costs go up slightly compared to running software in their own proprietary data centers. It's kind of like the AI tax that everyone is paying right now.
But the bulls and clearly management are screaming that this dip is a buying opportunity.
They're calling it turnaround alpha. The bull case is really simple, 98% renewal rate.
That number is just insane.
It is. Customers simply do not leave ServiceNow. It is too sticky, too embedded in their operations. And in a tough economy, companies cut the nice-to-have software. They don't cut the platform that runs their entire IT and HR departments.
They become the platform of platforms. They actually benefit from consolidation because customers cut smaller vendors to double down on them.
Exactly. And look at their 2026 guidance. They're still projecting full-year subscription revenue between $15.53 billion and $15.57 billion. That keeps them squarely on that 20% plus growth trajectory, even at this massive scale.
And Bill McDermott isn't just looking at 2026. He called ServiceNow a one-of-one company. He said he believes this is a $1 trillion company in the making.
$1 trillion market cap. That is an incredibly bold claim. That puts them in the same league as Microsoft, Apple, NVIDIA.
Do you buy it? Is that even remotely possible?
Look, if they truly become the operating system for the AI-powered enterprise, if every autonomous agent in the Global 2000 has to pass through ServiceNow's toll booth just to get its work done, then that number isn't impossible. It sounds crazy today, but so did the idea of an online bookstore becoming a $1 trillion cloud computing company 20 years ago.
A very good point. So let's wrap this all up. We started this deep dive by asking a simple question. Is ServiceNow the control tower for Agentic AI, or are they just legacy software about to get eaten?
And I think, after digging through all of this, the evidence strongly points to the control tower. They have successfully pivoted the entire narrative. They aren't selling the brain, the LLM. They're selling the central nervous system.
Oh.
And I think more importantly, they are selling the governance.
You know, the aha moment for me in all this is realizing that for big, serious companies, safety is actually a more valuable product than raw intelligence.
Say more about that.
Well, you can get intelligence anywhere now. It's becoming a commodity. But safe, auditable, integrated, governed intelligence that won't get you sued, that is incredibly scarce.
That's a great way to put it. They are the designated driver at the wild AI party. And when things start to get out of hand, the designated driver is the most important person in the room.
I love that analogy. Okay, so here's my final thought for you and for our listener to chew on.
Let's hear it.
If ServiceNow actually succeeds, if they really do become the control tower that governs this new digital workforce, then they effectively become the manager of that workforce. And in a world where AI agents might eventually outnumber human employees 10 to 1, or even 100 to 1, does the company that governs the agents hold more power than the companies that are actually deploying them?
That is a profound and slightly terrifying question. If you control the kill switch, you control the entire operation. You control the flow of all digital work on the planet.
Something to think about. And for a more immediate, tangible test of this entire thesis, keep your eyes glued to the Assist Pack consumption numbers when they report Q1 2026 earnings.
Follow the tokens.
Follow the tokens. That's where the story is.
That is all the time we have for today's deep dive into ServiceNow. Thanks for listening, and we will see you next time.